Hello, my name's Jordan Eliseo, the General Manager of ABC Bullion Australia. I'm delighted to welcome John Reade, the Chief Market Strategist from the World Gold Council, to Custodian Vaults, our purpose-built, high-security bullion vault located in Sydney, Australia. John, great to have you here.
Jordan, it's fantastic to be here. It's a few years since I've been in a vault, and to see all those thousands of safety deposit boxes around, and no keys, I should say, is a bit frustrating, but certainly a fascinating place to be.
Let's get into it in terms of talking gold. We've obviously had a very big uplift, a circa 20% $400 rally in the US dollar gold price over the last couple of months. What's been the main driver of that?
Yeah, I think the main driver has been the fact that the US dollar, which had been really strong for most of 2022, stopped going up at the end of October, beginning of November, and then weakened a bit. And the US dollar strength had been a clear headwind to gold, particularly the US dollar gold price all year. So you take that headwind away and gold was able to go up. So that's the biggest factor. But there's probably some other things going on as well, particularly regarding central bank purchases.
Great, so let's talk about central bank purchases, because that was obviously one of the real key themes that came out in your recent gold demand trends report. Over 1,000 tonnes, I believe. What were the main factors at play there?
Well, there's quite a lot to unpick there. I mean, it was over 1,100 tonnes, 1,136 tonnes for the full year, but it was very much backloaded. So about 800 tonnes of purchases took place in the second half of 2022. So that's the first point. Second point, I'd say, is the fact that so many of them were undisclosed. So there's two different types of purchases that we record for central banks. Each month we look at the IMF statistics to see how much gold each central bank owns, because they're required to disclose it every month. So we put a monthly report out of the changes that we can see in the central banks from either the IMF or maybe from the central bank balance sheets themselves. But then each quarter we get more information from our data providers, Metals Focus. They estimate how much central bank purchases are taking place based on the IMF data, but also on what's going on in the market for central banks and sovereign wealth funds that haven't reported. So the magnitude of these unreported transactions in the second half of the year was absolutely enormous and completely unprecedented. So not only was net central bank buying the highest on record, but also these undisclosed purchases were the highest that we've ever seen. What we'll typically see is some of these will probably be announced by central banks later, so our data gets a bit cleaned up, hopefully, but some may never be reported. The final one is, and I think equally as important as the size of the purchases we saw last year, is the fact that China, the People's Bank of China, reported increases in its gold holdings in November, December, and then just recently January as well. They're a very significant player in the central bank market because they've got the world's biggest foreign exchange reserves. So for them to be disclosing purchases of gold is a really big story.
John, let's move on to a part of the market that's been a lot quieter, talking central banks, and that's the ETF market. We obviously had huge inflows in 2020, but since then it's sort of been mostly divestment and a real lack of investor appetite. What do you think the main driver is, or key reason investors aren't buying gold ETFs these days?
It's a really good question, and something that I'm struggling a little with myself. I can understand why ETF investors were cutting positions towards the end of 2020 and into 2021, as they did, because people were reallocating towards the recovery from COVID. In 2022, I can understand why US dollar-based investors were cutting positions, not aggressively. I think the total year decline in ETFs in 2022 was 110 tonnes, but the US investors were cutting positions, and I can understand that when the US dollar was strong, because the dollar gold price was not really doing very much. But what I haven't really understood is why, with this near $400 rally in gold that we saw from lows just above $1,600 US dollars an ounce up to nearly $2,000 an ounce, we didn't see any return to the buy side. So I don't really understand what's going on there. Similarly, in Germany, I can understand why they've been cutting positions when the euro gold price started to go down, when the US dollar started to weaken. But I can't understand why they haven't bought more, particularly when you contrast that to the really strong bar on coin demand out there. So it is a bit of a quandary. I mean, I am hearing one thing that perhaps explains some of that is that my contacts in the bullion banks are saying that they're seeing a lot of interest for clients to open allocated gold accounts. So in other words, gold accounts that are sort of like the safety deposit boxes that we're looking at here. So there's no credit risk to the bank. And that might be being triggered by some of the weakness that we're seeing in some of the European banks particularly. So maybe rather than buying ETFs, which have very little credit risk, but still have fractionally some, actually buying the physical gold and storing them. So that could be the reason. But in general, I'm a bit perplexed. In light of this really strong bar on coin demand and the decent performance in the gold price later in last year and into this year, I really am surprised that ETF investors haven't come back strong.
And paradoxically, is that potentially a positive sign price-wise in the sense that they tend to sort of add to the momentum both to the upside and the downside? So the fact that they haven't yet started to reallocate could suggest we have some more upside?
Yeah, I think of it, when it comes to investment and speculation, I always think of it in terms of capacity. How much room is there for investors and speculators to add to the positions that they have? So on the ETF side, I guess there's plenty of room because they really haven't been buying very much. So that's a potential positive. Similarly, if I look at the futures market positioning from COMEX, yes, the net long position for managed money has increased a bit. Some short covering, some new longs, but it's nowhere near as high levels as it has been at various times over the last 3-5 years. So again, lots of capacity to add there. But you also need the trigger. Maybe it's the fact that inflation is coming down, people looking through the current period of gold price strength, and again thinking about, is this the time to add to equities? Is this the time to buy the dip again, which they've been doing pretty enthusiastically over the last few years?
John, you mentioned inflation as part of your previous answer. That was actually the next topic I was going to get to. Last year we saw inflation head to, let's call it around 10% in the US, above that in Europe and the UK. Has started to come down a little bit, but there are signs that it's maybe going to be a little stickier than what some forecasters and economists were hoping for. How do you see inflation dynamics playing out and the impact that it's likely to have or could have on gold this year?
Yeah, it's a crucial question. I think one of the things that we've seen is inflation becoming a bit more embedded, I think, than many forecasters were hoping for. And by embedded, I mean it's moving from headline into core, it's moving from goods into services. And if you think about the US economy, I mean, services are 70% of the economy, so that's becoming really important. So you can have as much supply chain disruptions as you like, boosting goods prices, but now it's actually into services. So I think inflation will be stickier than some forecasters are looking at. I think there's a chance that China reopening could make commodity prices go up quite a bit. So there's even a potential for headline inflation to be picking up again if the oil price, if wholesale LNG prices start heading higher again. So I think it's a really difficult position that central banks find themselves in at the moment, particularly the Fed. If you look at the economic data that's been coming out of the States recently, there's no sign of a recession across the whole economy. There's certain areas that are weak, sure, housing being one, and maybe some signs of manufacturing weakening. But look at non-farm payrolls, look at the services ISM. The Fed's got a real problem. It's hiked rates up to nearly 5%, and the economy's still booming. So I think they're going to have to take rates quite a bit higher, and they're going to have to keep those rates higher for longer than the market's expecting. So that's going to cause some volatility, I think, across financial markets, including gold, I think, later this year.
John, that's an interesting comment about, I suppose, recession risk in the US and I suppose across the Eurozone, other parts of the world. I mean, whilst, as you say, non-farm payrolls and a few other items are still fairly positive, yield curves as inverted as it's been in many decades, that's typically a sort of warning sign that a recession is somewhere on the cards, 12 to 18 months, 24 months in the future. At what point, or what's going to be the trigger, do you think, for the Fed to actually have to tilt towards more dovish policy?
Well, I think when it gets a recession. The Fed is not going to anticipate a recession until we've at least seen material slowing of the US economy. And at the moment, there are limited signs of that slowing. I think the Fed doesn't want to cut or become more dovish too soon. It has one chance, I think, in its mind to re-establish its credibility regarding inflation. And to be honest, if that means that we get a bit more of a recession than will prove to be the case after the fact, then I think so be it.
Yeah, and I think, I guess, if you look at, okay, there's a myriad of data points you can look at, but the two key ones, unemployment is clearly not a problem because it's at multi-decade lows. Inflation clearly is a problem because it's at multi-decade highs. The path for rates, or the path of least resistance, is rates go higher.
I think so. Go higher, stay higher. And if you think about what the Fed's dual mandate is, it's doing really, really well on the unemployment side and doing badly.
Very poorly.
So there's room for them to bring both of those measures back towards the middle. And if it means unemployment has to go up by 1% or 2%, if that gets CPI down or gets inflation down, I think the Fed will consider that a win. Of course, politicians and maybe investors may not, but the Fed really believes in the importance of maintaining its credibility and getting inflation under control.
John, let's switch gears for a minute, and we talked about China very briefly there, and the I suppose the reopening. How do you see that playing out, I suppose at a macro level, but also for gold demand in China? Because that's obviously been somewhat of a soft spot over the last couple of years. Do you have any comments on that?
Yeah, I mean, 2021 saw China gold demand basically rebound towards its trend level. 2022 obviously affected by the lockdowns that we saw across the country, which were really intensifying the second half of the year. So it's no surprise that jewellery demand was off a bit, although investment demand wasn't bad. But our analyst in China, Reade, is very positive about a recovery for jewellery in 2023. I mean, the first quarter is going to be affected by the reopening wave of COVID that China has probably finished with now. I mean, we're recording this in the middle of February, and I've seen some mobility data out of Beijing, for example, looking at the metro, and their ridership numbers are the highest they've been in 12 months. So, and I tweeted out at I said, hey, China's back. So the wave will probably take, I don't know, another couple of weeks, maybe a month to get through the rest of rural China. And obviously that will have consequences in the short term and will be very tragic. But once it's done, as we've seen out in the UK, as you've seen in Australia, COVID doesn't go away, but it stops causing so much economic turmoil. So there's a lot of savings that have been pent up in China, much as they have in many other markets. And I think there'll be some revenge consumption, which is a term that I've heard a little bit recently. Sure. In other words, you didn't get a chance to spend your money, so now you can, so I'm going to do it. Now, I think travel is going to be a big thing in China, but I think that jewelry will probably be good as well, and probably investment in gold as well. One of the things about the People's Bank of China announcing that it's adding gold to its reserves is that it seems to have a positive impact on Chinese people investing in gold. Sure. Because it's like, well, if they're doing it, we should do it too. So I'm pretty upbeat about China. I mean, obviously what we don't know is there will be another round of COVID later in 2023. But I think it's fair to say that we probably won't go back to the lockdowns that we've seen that really affected gold purchases. So I'm almost stopped following COVID as a trending story now after a few years, because it's probably not going to have any impact on gold demand. I think China will do pretty well this year.
John, last time we were here, there was stories and social media threads and tweets around sky-high energy prices in the UK and in Europe. There were people tweeting pictures of their electricity bill and the like. It feels like some of the heat has come out of the energy markets in the UK over the last few months. How are things, and in Europe, how are things playing out over there now? And does the economy feel like it's sort of finding a firmer footing, and the impact on gold demand as well in Europe?
Yeah, I mean, there's probably less news stories about high energy prices around the world, about Europe and the UK, but it's still very much a live issue in the country itself. And in fact, this government support for retail customers for energy prices runs out in, I think it's April. So prices probably go at the consumer level probably go up then. So it's not going to be a great story in the UK. Different countries in Europe have played this in different ways. I mean, in Germany, they're just burning loads of coal, not because they shut the nuclear power plants down, so they're just burning loads of coal, which I'm not quite sure how green that is, but anyway. So they've got enough electricity from there. So it's not a great feeling in Europe. It's probably quite a poor feeling in the UK, living there at the moment. And I've certainly seen, I think it was either the IMF or the OECD, that came out, and I think it was the IMF that came out and said that the UK would have the weakest economy of the developed world over the next 12 months. But Europe's in probably a somewhat better position. What I think will motivate certainly investment buying across Europe, though, is inflation, fears about Eurozone country stability, particularly worried about Italy, which is the one that seems to worry Northern Europeans the most because of its size and its fiscal position. And of course, the ongoing war taking place in Ukraine. So I think all the ingredients are in place in Europe, in the countries that buy most of the gold, so Northern Europe, German-speaking Europe predominantly. I think all those conditions are in place for another strong year.
So John, if I summarise the discussion we've had to date, we're sort of talking fairly weak to non-existent demand from gold ETF investors right now. Very strong physical bar and coin demand, which sounds like we should expect to see something similar this year, if not quite the same levels. Yeah. Ditto for central banks in terms of the strong demand we've seen there, and the potential for China reopening to really sort of pick up jewellery demand in what is clearly a key market for gold. So on balance, it feels like the market is fairly well set for 2023. Would you agree with that, or any caveats or qualifying comments to go with that?
I'd agree when you look at the breakdown of the demand areas that you've just discussed. Things don't look bad, and they actually could be quite healthy. The one thing that concerns me, though, is if the Fed has to become a bit more hawkish than the market's expecting. We may see volatility coming through in financial markets. We may see the US dollar start to rebound. So I think we could get a bit of US dollar gold price weakness until the market adjusts to the fact that the Fed has to hike a bit more than perhaps is priced into the curves at the moment.
Okay. Thinking through that from a local currency investor's perspective, that sort of scenario is probably not too bad for the Australian dollar gold price, because if the US dollar is rallying, that obviously helps boost the price of gold in Aussie dollars. And it sounds very much like that's a risk-off scenario anyway. So the sort of portfolio role of gold, its high liquidity, its lack of credit risk, all of those factors are still relevant in that kind of environment.
I think that's exactly right. I mean, from an Australian dollar perspective, I think the gold price will do okay in absolute terms and well relative to other assets. And that probably holds true around the world, with perhaps the exception of the US, where the US dollar price weakness will probably be an absolute underperformance. And then relatively, gold will probably do okay, outperforming other assets, but probably falling. But a lot depends. I mean, trying to predict what's going to happen with the US economy has been really difficult, and not just for you and I, but for the Federal Reserve as well, in the last 6 to 12 months. And I think that's going to continue, to be honest.
John, thank you so much for your time. Really appreciate you stopping by.
Thanks, Jordan. Really appreciate it.